Some breaking news here. A U.S. President-elect Donald Trump will get no jail time nor probation in his New York hush money case. The prosecutor agrees with an unconditional discharge for Trump. Trump calls the hush money case a terrible experience, quote unquote. Now, 2024 was a spectacular year for stocks, driven primarily by the artificial intelligence theme. Our next guest remains bullish on tech. However, he says this trade will evolve, and he is looking at some tech areas that were overlooked last year. Let's bring in Doug Clinton, founder and CEO of Intelligent Alpha. Hi, Doug. How are you?
Mark, I'm well. Thanks for having me on.
Absolutely. Thanks for coming on. All right. So you think the AI trade still has legs, but it will evolve in terms of software and hardware. Can you explain?
I can. I mean, 2024 was really a story about AI, but primarily about Nvidia. I mean, you look at the returns, over 200% returns for Nvidia last year. They were really the big winner. All of the hyperscalers were spending billions of incremental dollars on CapEx, buying their chips, building out these AI data centers. We still think Nvidia is a winner here, particularly in the first half of the year. But as we think about how the trade evolves in AI on the hardware side, I think we're going to be hearing a lot more about custom silicon. So companies like Meta, like Microsoft, like Google, building their own chips and primarily partnering with companies like Broadcom. And so I think that's one thing in the hardware space that we'll see evolve. On the software side, a lot of the story, I think, will be about agents, which is sort of the evolution from ChatGPT, which is just a simple interface where you ask questions and you get answers, to an agent that can actually go out into the real world and do things for you. For example, order a coffee from DoorDash or book a flight for you. That's the next evolution in the software side.
And then a couple of names you like within that, Broadcom and Marvell?
They are, and they both play on that kind of custom hardware side. Marvell is actually one of the top 10 holdings in our Livermore ETF, LIVR. And so we think those two companies can both be beneficiaries as companies like a Meta, like a Microsoft, which are also holdings in that ETF, spend more on some of this custom hardware.
And just quickly, you mentioned the name Livermore. Is that after Jesse Livermore, the famous speculator?
He's the inspiration. That's right.
All right, great. I read that famous book a long time ago. All right, so let's move on here to Nvidia. The trade's not done. How come?
I still think we're going to see the hyperscalers investing heavily into the new Blackwell chips, which now, as we know, there was a little bit of some hiccups at the end of last year that Nvidia was dealing with. It feels like they've sort of moved through all of those issues, and now I think we'll start to see pretty wide scale shipments of those Blackwell chips. I think that can be good for Nvidia. But again, as we get to the back half of the year, that's my sense, is that not that Nvidia necessarily will become a loser in the overall spend game. I think they're still going to be quite strong. I think it's more about the narrative, and we'll start to hear a lot more about these custom silicon projects. Google's been the most aggressive so far, building what they call TPUs with Broadcom as a partner, and I do just think that theme will be a bigger part of the story in the back half of the year.
Now, Doug, I understand you use some AI models, and what they've been spitting out is that the Federal Reserve will cut rates less this year than expected, and that seems to be a good call right now, and that there may be a correction of some sort in the second half of the year. So could you explain these AI models and how accurate they've been for you?
That's right. We use three models, Mark. One is GPT, the one that is built by OpenAI that probably many people have heard of. We also use Claude and Gemini, the two other leading models on the market. And those three models make up our investment committee. And we use them to make predictions about markets and also build portfolios of stocks that the models think will perform well in the market environment. And what we did at the end of last year was make some predictions coming into 2025. One of the ones that you mentioned was that the models did say, they said the back half of the year, maybe it's coming a little early, we'll see, but that we'd get a market correction of 10% at some point. And primarily the models were concerned about maybe some resurgence in inflation, potentially some new policies from the new Trump administration coming in around tariffs. And obviously, we've already seen so far this year some changes just in the interest rate expectations in markets, whether it's from those issues or not. It's certainly having an impact on markets. We're only down 4% from the highs in the S&P, so we're not really in correction territory yet. But I do think the models are just sort of aware of, hey, we've had a really great run here. 2 years, 10% correction over that time period. We're probably due for another one. And if we get these sort of volatile elements with interest rates, that might be the catalyst for it.
Now, speaking of those interest rates, there does seem to be a lot of consternation among investors that they're remaining elevated, higher for longer. But you make a good point that in the 90s, pre-bubble bursting, during the mid-90s, that tremendous run for tech and .com, that interest rates were quite high back then.
They were. I mean, they were in kind of the 5 to 7% range. And I'm glad you brought that up, because I think one of the common narratives right now is that if we are in an environment where rates are maybe more stable, where they are now, fewer cuts than we thought before, that tech can't work in that world. And I think that that's probably false. The reason people seem to think that is that we look back into recent history. We look at the period from 21 going into 22, where we went from, very low rates, where there was this everything bubble, to a higher rate environment. And a lot of the tech names got hurt by that. I think that was more of a byproduct of that specific environment, not just the rate issue. And I think if you do look back into broader history, there are periods where we have healthier rates in this 4 or 5% range, and names in the tech space with healthy multiples can still work. And I would also just add, if you look at the multiples right now that we're seeing in the Mag 6, so if you exclude Tesla, we're trading about 28 times this year's earnings, 24 times next year's earnings. The range of the last 10 years for that group is 18 to 36 times.
Right.
And so sometimes when we talk about tech, it feels like we're at the very peak of what multiples have been historically, and they're really not. They're sort of in this middle range, and I think tech can still work because of that.
Thanks for the insight today, Doug. We'll talk to you again.
Thank you, Mark.